We now just going to quickly go over the handout 1.3 and handout 1.4. As I mentioned in the first class, I think we're not going to go through a derivation of CAPM, since most of you should have taken financial economics. So we're going to skip that. Now, if you look at handout 1.3, then basically there is a plot of the stock price of Morgan Stanley and Goldman Sachs, and you can see that they are quite correlated. So CAPM is about the CAPM and the model beneath it is about, well, what should you do in the market when stocks are correlated? So we're just going to use a very simple example. We're just going to use a very simple example in handout 1.3. We're going to draw some diagrams. We can draw some diagrams to explain the underlying idea of CAPM. So multiple assets, and in this case, we're just going to use a very simple example. Let's say you have stock A, B, and C, and there are two states of the world, right? And with probability half chance, A is going to give you a high return, B is going to give you a low return, and C is also going to give you a low return. And probability half, A is going to give you a low return, B is going to give you a high return, and C is going to give you a very low return. You can easily calculate that A and B have the same average return and variance, right? So on average, A gives you 3, B gives you 3, and C only gives you 1, right? So C is obviously inferior in this case. You can also calculate the variance, right? And I believe in this case the variance is what? 8 plus 2, so that's what? 8 plus, so it's very hard to calculate variance in your mind. So it's half times 16, so that's 8, plus half times 4, so that's 2, so that's 10, right? Minus the square of the average, which is 9, so that's variance 1. And this is also 1. And the variance of this is also 1. All right. Okay. So this is the market in our example. You have two stocks paying well in alternating in like opposite states. And you have asset C, which is particularly bad in this case. What we care about is that, well, if we draw in the diagram, you will have return, average return, and you have variance, right? Then this is 1, 2, 3. Stock A and B are here, and C is here, right? Right. Now, we can form a mutual fund of half A and half B, right? Well, let's call this M, right? Let's call this M. And for M, half of the time you get the average of A and B. The other half, you also get the average of A and B, which is 3 in both cases. So the average is 3, but now you have no risk. So the mutual fund, it's on the left side. So this is the basic concept of hedging. This is the basic concept of hedging. You buy assets that cancel out each other's risk, and you're left with a return that is equally good, but with lower risk. So that's the idea. Now, in reality, you can rarely diversify all risk. So we have what we call systematical risk or market risk that you cannot diversify. So in the CAPM setting, usually you will see a diagram like the following. All right, so now from now on, we're just going to draw a diagram, okay? So just going to push this up a bit further. Once again, you have a trade-off between variance and average return. And typically, you have many assets in the market, but you can form combinations out of them, but you cannot diversify away all risk. So what you would get is something like this. This is what you have. Right. So you have an area. You have basically some minimum risk. So this would be market risk. You cannot diversify away from the market risk. Usually, now, usually would have a safe asset. That is, you can put your money in your bank. That would give you some return. So let's put that somewhere. Let's say here. This would be the risk-free asset. So this is like putting money in your bank. It will give you some return for no risk. Okay. Without this asset, you can only pick a point from that curve or from that curve. With this risk-free asset, however, you have a choice. With the risk-free asset, you can actually pick a point from all the combinations of stocks. And with that particular combination of stock and the risk-free asset, you can get a higher return for lower risk than if you just buy stocks alone, right? Through a combination of the risk-free asset and a particular portfolio from a particular portfolio of stocks, you can get a higher return for any given risk. Equivalently, for any given return, you can have it for low risk. So the blue line is called the capital allocation line because you're allocating your money between the risk-free asset and that particular portfolio of stock. Now, okay, so far we haven't made a lot of assumptions. Really, we're just saying, given the returns, this is what you have. Now, we're going to add in some equilibrium concept. Given that people are rational, right? You look at this, and what do you think? Well, there's no reason to buy any other stock. So everyone will end up holding this allocation of stocks plus some risk-free asset, because everyone is holding this combination of stocks at the same proportion, right? So this would end up the composition of the market. Furthermore, if you assume that the risk-free asset is in zero supply, that is, if I want to borrow money from the bank, someone has to save money in the bank. It would also mean that investment would balance out around the market portfolio. If I want a higher return, I can borrow money, buy more stocks. And if I am risk averse, I can buy less of the market stock, save part of my money into the bank, and earn a risk-free rate, right? So the point here in the middle is the market portfolio. And you can have people leveraging to buy more stocks, right? And you can have people who are mostly saving in banks, saving in risk-free assets. So these are the lenders. So that's the basic underlying setting in CAPM. Now, the CAPM model gives us a formula that comes from this diagram. What the CAPM model says is that intuitively, there is no reason that you want to deviate from this point when it comes to buying stocks, right? No matter whether you go to the left-hand side or right-hand side, whatever side you move towards in terms of your portfolio, they would give you a worse trade-off than this blue line. And that's the foundation of CAPM. It's basically an application of differentiation. It's application of differentiation. Since students keep complaining that we keep covering CAPM in 3 different classes, I'm not going to go into the mathematical details, but I'm going to upload the derivation if you're interested. But just let me write down the CAPM formula. So the formula is, and let me make sure that I use the same notation in all places. So, okay. Now, CAPM has a lot of assumptions. Basically the ones that you can typically think of. No transaction costs, no limitation of short selling, blah, blah, blah. Under these conditions, CAPM says that the return of any stock I should satisfy the following relationship. The expectation of RI should equal the risk-free rate from the risk-free asset, the return of the risk-free asset, plus a certain beta I, so this is unique to this asset, times the average return of the market minus the risk-free rate. So this is the CAPM formula. And beta I should have the following structure. It is the covariance between this asset and the market over the variance of the market. Once again, if you're interested in how this is derived, I'll upload the derivation later on. But let's think about what this means. It says that this holds for any stock in the market. This holds for any stock in the market. Now, this is why. So why would a relationship hold for every stock in the market. Now, the reason is everyone is holding the same stocks, right? Everyone is holding the same stocks in proportion. So stocks that no one wants to buy simply disappear from the market. Every stock earns a return that is equals to the risk-free rate plus beta times the market return minus the risk-free rate. This is called the excess return. This is the excess return over the risk-free rate. Now, how much over the risk-free rate you get depends on beta, and there is also a formula for beta, which is covariance over variance. What this comes down to is how much return a stock earns over the risk-free rate depends on the correlation of the stock with the market. This is essentially what it's saying. A stock earns higher return when it's more correlated with the overall market. Why? That has to do with the market risk. Ideally, what happening is this point is a point where you try your best to diversify all market risks that you can avoid. So any remain is something you cannot diversify away. When a stock is more correlated with the market, it's more correlated with this market risk. So it's something that you cannot avoid. It's something that you cannot avoid because it's just simply moving exactly with the market, just stronger, right? So you get more return from that. In some sense, this is just like leveraging, right? This is just like leveraging. You're amplifying the gains and losses, but it's in the same direction. If a stock is negatively correlated with the market, beta would be negative. And if beta is negative, you actually earn less than the risk-free rate. This is insurance. Because the stock helps you diversify, help you reduce the market risk. You actually not pay for it. You actually have to pay for it. You're not paid for holding it. You actually have to pay to hold it. Right? Now, that doesn't mean the return is negative. It just means the excess return is negative. Because the risk-free rate can be positive. So when you have a stock, that earns 1% return, when you can earn 3% from the bank, that tells you this stock has a negative beta, and the theoretical reason would be it helps the market to diversify risk. Right? What this model have in mind is that you're not paid for any risk that you can avoid. You're not paid for any risk you can avoid in the market. You only pay for risk that you cannot avoid, namely the market risk. You are paid more when the stock you hold is more correlated with the market risk. And you're paid less or even negative when it actually helps you avoid market risk. So that's the CAPM model, right? Everything depends on exposure to market. So okay, so that's the takeaway, and we'll